Hey, good evening, everyone. Marty Mazzara here. It's Friday, the 30th of January, 2026, with an end-of-week wrap for you. I'm going to start just by highlighting key events and some commentary from earnings statements of the week, and then jump into some charts with you. So, starting with the most recent, Kevin Warsh was nominated by the president to be the next Federal Reserve chair. Markets definitely reacted to that in not a great way, which indeed makes sense, at least on the surface, when you look at Warsh's history and what he has leaned into or leaned towards with regard to monetary policy, and that is more or less hawkish, certainly relative to the current regime, which is a surprise when you think about what the president has been lobbying for heavily in terms of Fed decision-making while he's been president. So just again, on the face of it, Kevin Warsh, not the most dovish fellow, at least given his history now. To garner that appointment, of course, he would have to sing a somewhat different tune. And I watched an interview with him today, and indeed, he is singing quite the different tune. So remains to be seen once he's in there, if he will indeed argue for tighter monetary policy than we've had. I certainly do not expect that despite his own history. At least for the next couple of years, I think he's going to have to lean dovish, or I think he will be indeed inspired to. Now, whether it was Kevin Warsh or Willy Wonka, quite frankly, the market is overemphasizing the importance of that appointment. Folks, never forget that despite what the headlines and a lot of the rhetoric and the media conversation might imply, the Fed governor is literally just one of 12 votes. We had a Fed meeting this week, which was an absolute non-event. Jobless claims were little changed at 209,000 versus 210 last week. Continuing claims dipped a little bit. The apartment list rent index for new leases fell 0.2%. They're down 1.4% year over year. By the way, I'm giving you the positive highlights of the week so far. The November National Home Price Index rose 1.4% year over year, about as expected. The January Chicago Manufacturing Index actually jumped to 54 from 42.7, which is just the second time the index had a 5 handle since the summer of 2022. We've actually been in quite the recession in the manufacturing space. These indexes are priced at 50 to delineate between expansionary conditions and contractionary conditions. So as of January's survey for the Chicago Index, we are back in expansion mode for the first time since 2022. MasterCard overall, we continue to see healthy consumer and business spending. Royal Caribbean, the year is off to a strong start. Booked load factors remain within historical ranges at record rates, with approximately 2/3 of 2026 inventory already booked. From Apple, the demand for iPhone was simply staggering, with revenue growing 23% year over year, an all-time record across every geographical segment. From Meta, our business also performed very well, thanks to record-breaking holiday demand and AI-driven performance gains. From Microsoft, with cloud, we continue to see strong demand across workloads, customer segments, and geographical regions. From Caterpillar, their power and energy business led the growth as power generation grew 44%, driven by strong demand for large gensets and turbines used in data center applications. We've talked a lot about that of late, the energy demand for that, and some of our allocation in that direction in the core portfolio this year. From Starbucks in the U.S., where much of our turnaround work has been focused, company-operated transaction comps grew year over year for the first time in 8 quarters. From Brinkers, Chili's comps are still robust, up 8.6%. outpacing the casual dining industry by 680 basis points. Texas Instruments, the overall semiconductor market recovery is continuing. From UPS, 2026 growth in the U.S. small package market, excluding Amazon, is expected to be up low single digits. From GM in the U.S., we achieved our highest full-year market share in a decade. From LVMH, organic growth slightly negative on the year, but positive in the second half. The results of the group are solid in a rather challenging, disrupted climate economically and from the geopolitical standpoint, blah, blah, blah. So that's Louis Vuitton. From American Airlines, premium continued to outperform main cabin. We've talked a lot about this K-shaped economy. So premium seats are actually continuing to do really well. So people who have the money to pay up for luxury while flying, that segment's doing well. Coach is suffering a bit, or has been. From Capital One, the U.S. consumer and overall macroeconomy remain resilient. Tokyo core CPI rose 2.4%, 0.2 less than anticipated, and also down 0.2 from December. We actually are overall bullish on the Japan setup. We're long the yen and we're long Japanese stocks going forward. Germany unemployment was unchanged in January versus the estimate of a slight 3,000 person increase. Unemployment rate held at 6.3%. Eurozone Economic Confidence Index did lift to 99.4 from 97.2. Bank of Canada held their overnight rate steady. Swedish Riksbank held its policy rate unchanged as well. Now, the negatives for the week, real quickly. Before today's sell-off, the raw industrials index closed at its highest since 2022, so that would be an indication of inflation. Headline producer price index in December rose 0.5% month on month, well more than the estimate of 0.2%. Core PPI jumped by 0.7% month on month. So those are pretty notable jumps. And by the way, that was today. So I talk about Kevin Warsh, and that was what all the headlines talked about. But these PPI numbers could also maybe do a little bit of a number on sentiment right here. Now, you would say that inflation might be good for commodities, but we're going to talk about how commodities have been trading. Leveraged loan market is showing some stress. We're seeing that in some of our indicators as well. Mortgage applications fell 8.5%, all because of a 16% drop in refinances week on week. The January Consumer Confidence Index from Conference Board fell to 84.5, the softest since May of 2014. And I've been showing you how, despite how equity markets are holding up and certain segments of the economy are doing well, the overall consumer sentiment surveys are not painting a rosy picture in terms of how consumers feel about their lots right here. The January Richmond Manufacturing Index remains below zero at -6 versus -7 in December. Sherwin-Williams, at this time last year, we talked about the potential for a softer, for longer demand environment, and that is exactly what we saw. Whirlpool, as we discussed in prior calls, existing home sales are the most important driver for discretionary demand, which inherently is more margin attractive. However, the mortgage lock-in effect coupled with lower consumer confidence has led to a 30-year low of existing home sales, etc. Meritage Homes, the fourth quarter of 2025, ended the year marked by much softer than anticipated market conditions. Tractor Supply, their spokesperson, I want to acknowledge that our fourth quarter results came in below our expectations, reflecting a shift in consumer spending with essential categories remaining resilient while discretionary demand moderated. And emergency response was absent versus last year. From Apple, from a memory point of view, memory had a minimal impact on Q1. We do expect it to be a bit more of an impact to the Q2 gross margin, and that was comprehended in the outlook of 48 to 49%. Beyond Q2, we don't obviously provide outlooks beyond the current quarter. So they're talking about the cost of the memory chips and so forth and potential threat to their margins. Eastman Chemical, they referred to the macro landscape as a challenging operating environment for the chemical industry. From Meta, on the negative side, we anticipate 2026 capital expenditures, including principal payments on finance leases, to be in the range of $115 to $135 billion. And with year-over-year growth driven by incremental investments in support our Meta superintelligence labs and so forth. So folks, we've spent some time, and I know we'll spend more time in the coming months, if not years, on this massive data center build out and the monetization that's going to have to occur for all of this spending to make sense. Microsoft capital expenditures were $37.5 billion. Roughly 2/3 of our capex was on short-lived assets, primarily GPUs and CPUs, and we've talked about that as well. UPS outside the U.S. exports growth is expected to be subdued. And there's more, but I think you get the mix. And there's a few negative points internationally. I don't want to belabor that too much. But essentially, folks, what we have from a macro standpoint and economic standpoint is a very mixed picture. Our own PWA index, which has 43 data points in it, gives us a feel for general conditions. Its latest reading is literally back to zero. Remember, we went positive there for a week or two. And right now it just sits on that neutral line between odds favoring expansion versus contraction. We don't see a contraction coming in the foreseeable future based on the massive amount of fiscal stimulus that really is getting and will continue to get injected into the U.S. economy and other economies for that matter. It doesn't necessarily mean that the environment is great for assets or risk assets, but it certainly isn't bad for equities, at least by itself in terms of the stimulus that's coming. Where it becomes problematic, as I've said over and over again, is that you couple that with what we expect, and that would be abating geopolitical headwinds, and you may have a little too much oomph and get more of what we just saw in the PPI numbers, and that's rising inflation, which ultimately equate to rising yields, which ultimately, a la 2022, can become quite the problem, at least for the equity markets and of course the fixed income markets as well. Okay, so we'll just jump to the charts and I'll hit the usual suspects. This is our one-year daily chart of the S&P 500. And folks, we continue to sit right where we sat here at the end of October, right? That's just right on that line. Not really able to sustainably break above those levels. All the while, we have a bearish divergence in our key momentum indicators. Again, these are not sell signals, but they do tell you to expect potentially something not so good to the downside. We broke the 50-day moving average. It provided nice support, came back above it again, and just kind of dancing along that line where the all-time record was set back in late October. And we'll just focus on the daily charts today. The NASDAQ 100 index, or in this case, the ETF that tracks it. Remember, we had this symmetrical triangle. I said we tended to break out of these with force, and we did to the downside. We filled that gap right away, came back, look at this, just resistance right at the all-time high, again, from late October, and then dropped off of that. Strong drop today below the trend line, finding support at the 50-day moving average, closing below the 20-day, which seems to be very important for this particular market. And then same thing, negative divergences in the MACD, moving average convergence, divergence, and in the relative strength index. So, of course, time will tell. But again, as I keep saying, the dynamics and what's to come, tax refunds are going to be big this spring and so forth. It's hard to be bearish on U.S. equities right here, but clearly, with the kind of volatility we've seen of late, anything can happen in this environment. We are very late cycle for sure, and stocks are trading in the U.S. at very high valuations, particularly in the tech space. The dollar has been an interesting trade. Remember, we are long-term bears on the dollar, which expresses itself very nicely in our favor throughout 2025, right? Came into 2026, I said, I think there's reason to expect support for the dollar. We got it. Rolled over right at 100 on the DXY and just kind of careened lower, right? The dollar was up about 1% today. That's this big up candle right there. And that helps explain, what happened to commodities today in particular. So it would not surprise me to see the rally continue here for a bit off of these levels. Having said that, this is a bear flag pattern building. And if that were to play out, we might have another day or three upside before the dollar rolls back down. And if that were to happen, this fall off in commodities could be relatively short-lived, although these correlations have kind of broken down of late. So commodities could indeed fall with a falling dollar as well. Speaking of commodities, precious metals has been our focus of late. So here's gold. Wednesday was right here. We continued to ramp up. Then we had quite the decline, came all the way down to here. It was notably in the red at one point, and then actually came back and closed slightly above the candle the day before. We talked about that internally, and I said this is just so ripe for a precipitous decline, and we got that today. So we got this massive gap lower today, and gold closed down, and at one point it was down as much as 10%, and on the day gold closed down 10.27%. Literally, as we were rolling our hedge closer to the money right here, I was explaining to Nick, who does all our trading, that we are going to see literally single day moves of 10% down in the metal. And it was like the next day that we saw it. I wasn't necessarily anticipating it, but these technical levels, and it really, the monthly chart, as I showed you last time, that is telling us that we need to look out below right here. So remember I mentioned gaps, just about filled this gap right here, a little more to go to the downside. Gold could have a lot further to go to the downside, but it could get saved right here as well. And we could get some more buying. I mean, people are bullish gold, and I think they should be for the long term. I would like to see it take a deeper dive right here. We're feeling good about the hedge that we have on there right now. As for silver, which we own, which we haven't been dynamically hedging, we've just been cutting. So we cut silver in half to enter the year. Just a few days ago, we cut it back to target because it was up another 50% in like 3 weeks. And remember, I showed you on Wednesday night how dramatic the declines can be in silver. The last the two I featured were 90 and 76% declines respectively. Folks, we literally had an over 30% decline intraday, closed down right about 28% on the day, on one day in silver. So that tells you how volatile these things can be. Silver has a very solid thesis underneath it when you look at its precious metal dynamics along with its industrial dynamics, which aren't small. But as I mentioned last time, as it gets expensive, the industries that utilize it will indeed find ways not to use it as it gets, crazy expensive like it was right here. Where does it go from here? A friend of mine reminded me to look at the Fibonacci ratios today. And sure enough, if you go back to this 2025 low for silver, and then you track the rally, this 50% Fibonacci retracement is key, and that's virtually right where it ended today, right? So you got that bounce, plus you have double support with the 50-day moving averages. So this bounce made a heck of a lot of sense off of these levels. You essentially had double support. So it would make sense, perhaps. I don't know if we'll go back and test these highs again. We could. But I think there's a lot of downside risk still in silver. So basically, we're just mitigating that by having a smaller position. Last year, our position was more than twice what it is right now. We will, as long as our thesis holds, we will add it back. But not just yet. It would have to be lower levels before we did. There's, again, just too much of a good thing. Parabolic move. Again, talked about that on Wednesday. With commodities like silver, though, you have other dynamics too. Like, for example, the CME raised margin requirements, and China has done that recently as well. So when something gets just parabolic like this, the exchanges begin to get nervous, and they start thinking about, the kind of risk that could ultimately be systemic and just too much speculation. So when they raise margin requirements and people are long big time in their accounts, they generally have to come in with more capital to maintain those positions or sell the position. So no doubt there's some selling going on just because of that. And then that can trigger stop losses. It will literally trigger margin calls as the value drops, and suddenly the equity drops with it. So no doubt some of those factors were in there probably in a big way. As I said Wednesday, so much of this we think is just pure speculative fever, fear of missing out. And those things, particularly in commodities, can get corrected in a hurry. And by raising margin requirements, you help that in a hurry, as you can see. So we'll see how this plays out. Wouldn't surprise me to see a bump early in the week next week, but I'm not holding out for a new sustainable, measurable move into all-time highs. Should talk about platinum since we own it, but again, we've cut the position measurably. It was good, really, really good for us last year and at the beginning of this year. It was down like 18% today, so you can see that big gap today. That gap will ultimately get filled. I think it'll come back, but we'll see when. We're just going to be very patient with smaller allocations here for now. I mentioned consumer confidence, but we don't need to go through those charts again. Breadth today was interesting. It wasn't a horrible day for the market. It was down by 0.43%, but it was really tough for materials, down 1.8%. Tech was down 1.3%. And of course, materials is going to reflect the hit that we saw in commodities pretty much across the board. But there are only 4 sectors in the green. Consumer staples, which is not small for us either, which helped, of course, today. And it'd be interesting to see as we meander into next week. Again, the headline today was Kevin Warsh, but Kevin Warsh is not going to allow his history to be a problem for markets. So look for him to sound a very different tune than what he is normally disposed to talk about. He's going to have to. And obviously that was the promise he made. So that'll be interesting to see how it plays out. But again, let's not put too much weight on that other than just short-term market reactions, because there's 12 folks there who get to decide on monetary policy. So, folks, I will leave it there. I could come back to you over the weekend as I do the deep dive that I do every weekend if I think there's more to share. Otherwise, I'll talk at you next week. Thanks as always for watching and listening. Hope you have a great weekend. Take care. Bye.